Oil powers our modern world. We fight wars over it, grow food with it, manufacture endless products, and transport those products with it all over the world. So why is this commodity that is so important to run the modern world might just be the next bubble that is waiting to burst? The world's energy consumption has been increasing. As the world and the US energy demand grew, the US looked to become more energy independent.
We must reduce our vulnerability to potentially devastating embargoes. We can protect ourselves from uncertain supplies by reducing our demand for oil.
Our goal was and remains increased energy independence for America.
After years of talk about reducing our dependence on foreign oil, we are actually poised to control our own energy future.
6 brand new initiatives to propel this new era of American energy dominance.
This caused the US to up their production in oil and natural gas. The US today is actually a net exporter of total energy. To keep up with this increased demand, the US has been relying on hydraulic fracturing, or fracking for short. The technique first started in the 1990s, and it works by injecting high-pressure liquid to break open rocks and release oil and gas. This process is making more gas and oil accessible that previously was not workable by traditional oil wells. More than 1.7 million US wells have been completed using the fracking process. Compared to conventional oil wells, fracking wells are much more expensive to get started and to operate. It is estimated that the cost per barrel of fracking is between $40 and $90 per barrel. This is compared to the conventional oil, which some countries such as Saudi Arabia can produce at under $10 a barrel in an average worldwide price of around $30 to $40 per barrel. As traditional untapped wells become more rare, many smaller energy companies are turning to fracking to try and open unclaimed untapped wells that conventional drilling couldn't get to. They are also trying to innovate on the fracking technique to try and bring the cost of fracking down so it can compete with traditional drilling. These companies need a lot of capital to get started. A lot of them turn to private equity funds and taking out long-term debt. These private equity funds are often made up of pension funds looking for high returns. It is estimated about 1/3 of all fracking investments come from private equity. This is all fine as long as the demand for oil outpaces the supply. They can justify the increased price per barrel from fracking and have no problem meeting their debt obligations. Many of these companies were working heavily on assumptions. One of the biggest assumptions they were making is that fracking wells last just as long and produce just as much oil and gas as conventional wells. But as they are seeing, this is not true. Fracking wells tend to have a lot shorter half-life than a conventional well. This is a big problem since they are more expensive than a conventional well and are receiving less production from these wells. This is creating a domino effect with smaller energy companies going bankrupt because they bet big on fracking. Since 2015, 200 fracking, exploration, and production companies have gone bankrupt. This amounted to around $100 billion in debt defaults. In 2018, the top fracking producers spent around $6.69 billion more than they earned from their operations. This has a cascading effect since 1/3 of funding comes from private equity. A lot of pension funds' investments are uncertain and are being hurt by these bankruptcies. The outlook of these pension funds are at risk of not being able to pay out their employees. A majority of fracking-based energy companies, such as Chesapeake Energy, Pioneer, and EOG, all downgraded their outlook on future profits of fracking. Bigger companies with more resources, such as Chevron and Royal Dutch Shell, or better known as just Shell, look to start dipping their toes into fracking. Companies like Chevron and Shell have more resources to fund fracking from their other revenue sources. They are trying to learn from the mistakes of the smaller energy companies, but they too are having the same struggles. In 2019, Chevron wrote the value of its fracking assets down by $10 billion and stated that the fracking division won't be profitable anytime soon, and Shell took a $2 billion loss from fracking. As the world is in lockdown trying to contain the virus, this is bringing down the only thing fracking has going for it, which is the constant increased demand for oil. As people are driving less and air travel grinds to a halt, so does the demand for oil. If you don't stop producing oil soon, you'll have too much supply and no one who is looking to buy. This cut in demand and oversupply brings the price of oil down. It costs more to produce oil now than what people are buying it for. This seems like an easy solution. Just stop producing oil, and the supply will soon meet back up with the demand. In an economic sense, this strategy will definitely work, but in a geopolitical world, some people might like this more than others. OPEC is an organization of countries that are some of the top producers of oil. They set the amount they will produce so the supply never outruns the demand. China is the biggest oil importer. After the lockdown in early 2020, they began turning away oil tankers, since they no longer had the demand for that much oil. Since they were the first to go on lockdown and are the largest importer, the world's global oil demand took a big hit. OPEC and other top oil producing countries met to discuss the issue in China and what could be done to stop a severe drop in oil prices. Unfortunately, this meeting ended with a price war between Saudi Arabia and Russia, with neither of them agreeing to cut production, but rather flood the market with more oil, bringing the price down. At the heart of this fallout is Russia's anger over the US sanctions targeted at its biggest oil company, Rosneft Trading, which continued selling Venezuela's oil, which has the biggest reserve in the world, while the country was on the brink of collapse. Russia was hoping to get Saudi Arabia on the side to inflict pain on the US oil producers, as they believe the US has been getting a free ride from OPEC's production cuts, and it would further solidify the US as the world's largest oil producer. Saudi Arabia did not agree to this and began cutting the price of its own oil to hurt Russia's oil prices and their overall economy, since their economy is heavily oil dependent. From the price war and the decrease in demand, this caused oil prices to drop from $64 a barrel to around $19 a barrel. With oil prices still around their all-time lows, the bleaker the outlook is becoming for energy companies. The longer these lockdowns last, the worse it will be for oil and fracking companies of all sizes. These low prices are great for consumers though, because filling up your car is going to be a lot cheaper now, but this has unseen consequences. Since oil is so cheap, it will have an effect on alternative energy markets as well. Energy sources such as solar and wind are typically more costly to implement and don't yield as much power per dollar as oil and natural gas. Companies looking to get into alternative energy might not want to pull the trigger yet, since oil prices are so low. Automakers might also push back their electric models, as consumers won't be burdened by the high prices at the pump. They also won't want to pay the high premium for these electric cars anymore, since tax incentives for electric vehicles are decreasing and gas at the pump is so cheap. If the demand doesn't pick back up, this might be the end for the energy sector as we know it. Alternative energy won't be heavily invested in. Severe consolidations and bankruptcy throughout all parts of the energy sector will occur. This will have a ripple effect through all sectors in the global market. Do you think fracking will have a place in the production of oil in the future, or is the cost just too great? Will oil demand ever pick back up, or will the energy sector be forever changed? Is this the start of a new global economic crisis? Or if you have any other comments, I would love to hear what you have to say. Thanks for watching.